It's Saturday morning, January 31st, 2026. A few hours ago, I pulled up my terminal to check the damage. Spot silver is sitting at $78.53. That's down from $121.50. If you were long on leverage, you just got vaporized. The charts look like a crime scene. Red candles stacked on top of red candles. $30 wiped out in what felt like a heartbeat. And if you opened Bloomberg or the Times of India this morning, the story is already written for you. The end of the silver bubble. Profit taking after Kevin Warsh nomination. Stronger dollar kills the trade. They're telling you the party's over. The bubble popped. Move along. But here's what they're not telling you. While you were watching that price collapse on your phone, 33 million ounces of physical silver were ripped out of the COMEX vaults. Not next week. Not over the course of a month. In the span of days. The screen is lying to you. The price says one thing. The vaults are screaming something completely different. I'm a commodities analyst. I've been trading physical silver for over a decade. And I built this channel because I got tired of watching retail investors get fed garbage information 12 hours too late. I have access to Bloomberg terminals, vault reports, the kind of data that does not show up on your brokerage app until the institutions have already moved. And what I'm seeing right now is not a market rejection. This was a paper massacre. Orchestrated, timed, executed with surgical precision to shake out every overleveraged retail trader while the physical inventory hits a decade-long low. The nomination of Kevin Warsh gave them the perfect cover. A stronger dollar narrative. A macro story that sounds clean and logical. But if you look at the actual mechanics of what just happened, the math doesn't add up at all. So here's what I'm going to show you. I'm going to walk you through why this market is currently in a state of backwardation, a rare technical condition that proves the physical shortage is getting worse, not better. I'm going to run the numbers on the vault drain, and I'm going to tell you exactly what my personal 72-hour battle plan is, because I've seen this playbook before, and I know how this ends. Let me give you the hard data first. Timestamp. Earlier this morning, spot silver, 78.53. The dollar index, DXY, is at 96.73. The gold to silver ratio spiked to 63 to 1. That's a massive move in a single session. On the surface, this looks like a textbook macro flush. Warsh gets nominated, the dollar rallies, commodities get crushed. Simple story, except for one glaring problem. And while the paper price fell 36% from the high, COMEX registered stocks, the physical silver actually available for delivery, are sitting at 113.27 million ounces. That is the lowest level since 2016. Let me say that again. The price is collapsing, but the physical inventory is at a 10-year low. 26% of the registered vault inventory disappeared in 1 week. Stop. Look at this divergence. If silver was truly in a bubble, if this was genuine profit-taking, if the trade was over, why are the vaults emptying at the fastest rate in modern history? Why is physical metal flying out the door while the paper contracts are getting obliterated? This is not what a normal market correction looks like. This is what a liquidity crisis looks like when someone is trying very, very hard to make it look like business as usual. Now, let me explain the smoking gun. The word you need to understand is backwardation. I know, it sounds like financial jargon, but this is the single most important concept to grasp if you want to understand what is actually happening beneath the surface. So let's pull this apart. In a normal market, you pay less for future delivery than you do for immediate delivery. That makes intuitive sense, right? If I'm selling you a car and you say, I'll take it in 3 months, I can give you a better price because I have time to manage my inventory, arrange logistics, whatever. But if you say, I need it right now, today, I'm going to charge you a premium because that's harder for me to fulfill. That's a normal functioning market. Backwardation is when that relationship inverts. It's when you pay more to have the asset today than you pay to have it delivered 3 months from now. Think about that for a second. Why would anyone accept less money for future delivery unless they were desperate to offload the contract? And why would anyone pay a premium for immediate delivery unless they were desperate to get their hands on the physical asset right now? Here's the analogy. Imagine a car dealership running a massive clearance sale. They're handing out vouchers. Paper contracts that say redeemable for 1 car. The vouchers are dirt cheap. Everyone's buying them. But if you actually walk into the showroom and say, I want to drive a car off the lot today, they charge you double. Why? Because the showroom is empty. They've got 1,000 vouchers outstanding, but they've only got 50 cars in the back. The paper market and the physical market have completely decoupled. That is what backwardation signals. Physical desperation. And it's a death trap for short sellers. Because if you're short silver on paper and the price is crashing, you're feeling pretty good, right? You're winning. Except when it comes time to deliver the physical metal to close out your position, you can't find it. The vaults are empty. The premium for immediate delivery is skyrocketing. You're stuck. You either pay the premium and eat the loss, or you roll your contract forward and pray the situation improves. Spoiler, it's not improving. So when I see backwardation holding steady even as the paper price craters, I'm not looking at a market that's correcting. I'm looking at a market that's breaking. The mechanics are failing. The system is running out of physical metal, and the paper price is the last thing left that they can control. Now, let's talk about the math, because this is where it gets really uncomfortable for anyone who thinks this crash was justified. I'm going to give you two scenarios, one conservative, one stress test, and you can decide for yourself which one feels more realistic. Scenario A, the conservative case. Bank of America put out a note a few months ago saying silver's fair value is around $60. That's based on historical demand patterns, industrial usage, the usual models. Let's take them at their word, $60. Even at $78 right now, silver is historically undervalued relative to the M2 money supply. The amount of fiat currency in circulation has exploded over the last 5 years, but silver production hasn't kept pace. Add in the surge in AI-driven industrial demand, data centers, semiconductors, solar panels, electric vehicles, and you've got a structural deficit that isn't going away. At $78, we're not in bubble territory. We're barely scratching the surface of what this metal should be worth in an inflationary environment with supply constraints. Scenario B, the stress test. Let's talk about the vault exhaustion math. At a drain rate of 33 million ounces per week, the COMEX registered vault reaches zero in less than 4 weeks. Now, will it actually hit zero? Probably not. They'll find ways to slow the bleed. Margin hikes, delivery delays, cash settlements. But here's the problem. There are 528 million ounces of paper contracts open for March delivery. The vault has 113 million ounces of physical metal. That's a 4-to-1 deficit. The math literally does not work. Someone is not getting their silver. And when the music stops, the people holding paper contracts are going to find out that their claim on physical metal was always an illusion. This isn't conspiracy theory. This is arithmetic. You can pull the vault data yourself. You can check the open interest on the futures contracts. The numbers are public. They just don't make sense. And that's the point. The system has been running on the assumption that most people won't ask for delivery. But that assumption is breaking down. And when it fully breaks, this crash is going to look like a gift in hindsight. Now, I know what the skeptics are going to say. I've heard it all week. The Warsh Fed is going to raise rates and kill inflation. Silver is a dead asset in a high-rate environment. This trade is over. So let me steelman that argument and then dismantle it piece by piece. Yes, Kevin Warsh is a hawk. Yes, higher rates make holding non-yielding assets like silver less attractive on paper. But here's what that argument misses. Industrial substitution takes years, not days. Solar panel manufacturers, EV battery producers, they can't just pivot to copper overnight because silver got expensive. The infrastructure is built around silver. The supply chains are locked in, contracts are signed. Even if rates go to 5%, 6%, industrial demand doesn't evaporate. It slows down maybe, but it doesn't disappear. And here's the kicker. The narrative that higher rates always kill silver is historically illiterate. In 1979 to 1980, silver went to its then all-time high, while Paul Volcker was aggressively hiking rates. Why? Because the market wasn't reacting to nominal interest rates. It was reacting to currency debasement, geopolitical instability, and a loss of confidence in the financial system. Sound familiar? Rates are one variable. They're not the only variable, and right now the trust in paper markets is eroding faster than any rate hike can repair. So what happens next? Let me walk you through what I'm watching over the next 72 hours and beyond. First, expect the CME to step in with margin hikes. They always do. When volatility spikes and the vaults start looking thin, the exchange raises margin requirements to force small players out. It's a standard move. They'll frame it as responsible risk management, but what it really does is flush out retail leverage and give the big players room to maneuver. If you're holding futures contracts on margin, you need to be prepared for that. Don't get caught off guard. Second, I'm watching the silver lease rates like a hawk. Right now, they're sitting at 39%. That is not normal. Lease rates are what it costs to borrow physical silver in the wholesale market. When they spike, it means someone, somewhere, needs metal urgently and is willing to pay a premium to get it. 39% tells me the shortage is real. It's not a paper fiction. It's not a narrative. It's a structural problem, and it's getting worse. Third, I'm tracking the buyback status at major dealers. There have been rumors this week that some bullion dealers are struggling with liquidity, that they're not buying back from retail customers at the usual spreads. I can't confirm that across the board, but if it's true, it's another data point that says the physical market is seizing up. Paper price crashes, but you can't actually get your hands on metal at that price. That's the definition of a broken market. Here's the checkpoint recap. The price is down, the vaults are empty, lease rates are screaming, the Fed is in chaos, the mainstream narrative says the bubble popped. The physical data says we're on the edge of a supply crisis. So what does that mean for next week? It means we're in a high volatility, low visibility environment. The kind of market where fortunes are made and lost in a matter of days. And that brings me to my personal battle plan. This is not advice. This is what I'm doing with my own capital, and you can take it or leave it. I'm not looking at the $78 price tag right now. I'm looking at the $75 support level on the weekly close. If silver holds above 75, that tells me the paper flush was just that, a flush. A liquidation event designed to shake out weak hands. If it holds, I am expecting a bounce back toward 90 within the next 2 weeks, as the physical shortage reasserts itself. But here's my buy trigger. If silver dips below $70, and this is a big if, but lease rates stay above 10%, I'm personally looking to add to my physical position. Not paper, not futures, physical metal. To me, that would be a gift. A price that's disconnected from the underlying physical reality. And I would take full advantage of it, because I've seen this movie before. The paper market panics, the physical market tightens, and 6 months later, everyone's asking how they missed it. On the other hand, if the price rockets back to $100 on Warsh pivot rumors or some Fed dovish signal, I'm sitting on my hands. I do not chase green candles in a liquidity crisis. I've been trading long enough to know that the fastest moves up are usually the most dangerous to buy into. I'd rather miss a rally than get caught in a bull trap. This is how I am navigating the volatility without getting shaken out by what I am calling the paper massacre. I'm focused on the physical fundamentals. I'm watching the vault data, I'm ignoring the noise, and I'm positioning for a scenario where the shortage becomes undeniable and the paper market has to reconcile with reality. Let me bring this home. The crash you saw yesterday was a paper event. The physical shortage is accelerating. Backwardation is the smoking gun. The vaults are being drained at a historic pace. The lease rates are flashing red. The math on open interest versus registered stocks is broken. And the mainstream media is telling you it's over. They're wrong. They're not lying, necessarily. They're just looking at the wrong data. They're reading the screen. I'm reading the vaults. And the vaults are telling a completely different story. The screen says the party is over. The vaults say it hasn't even started. If you want to understand how the gold to silver ratio just predicted this exact move, and why the 1980 crash is the historical template for what's happening right now, you need to watch my breakdown of that period. I go deep on the mechanics, the players, the end game. It's the missing context for everything you just heard. Link is right here. I'll see you there.